What is going on, everybody? This is Andrew from DeFiancy. All right, guys, we're just going to jump straight into this per usual. So we are approaching the market close for legacy markets here in the United States, and it's been a pretty interesting session. We're going to go over kind of the lower time frame, and then we're going to go over the higher time frame for the S&P 500, talk a little bit about the macro mechanics behind where prices could go over the next few weeks, talk a little bit about the past in that respect, and finish off talking about crypto. But let's zoom in here and talk a little bit about what has happened today. So today was actually a really good trading session. Just enough volatility, enough opportunities to make some pretty good scalps. And we can see that we gapped up. Let me actually remove some of this so we can see this a little bit better. We can see that we had a gap after the market opened. So if you don't know what that means that futures had a big move pre-market, and the S&P 500, the underlying asset, actually opened pretty much at the high today, almost. It went up a little bit after that. But what we ended up doing by the end of the session was filling in this gap, and that is really normal. So this is very typical price action, despite what some people might say, like, oh, look at that big rejection. If you look at the daily here, you'll see that it is a pretty big slap down, so to speak. But we need to look at this in a broader context, but to really, I think, appreciate the price action now or really get a better understanding of it. But let's zoom in again and talk a little bit about this. So we filled in this gap, okay? Why is that important? Okay, boomers, legacy markets, they like to fill in gaps, okay? Why this actually happens, there's theories on it, and I'm sure people have a better understanding, but we're not going to go into that. But usually these gaps like to get filled, and as you can see, this gap has gotten filled, and basically the market was net zero for the day. Like the S&P 500 was pretty much at no gain for the day. The NASDAQ is still up about 50% at the close, or near the close here. So if we look at futures contracts, you're still up for the day about 50 points. Okay. If we zoom out a little bit, you can see that this market is really grinding higher, and a better way to put it actually is it's consolidate. So you have moves higher, big move higher, consolidation, another big move, and now you're at resistance. So if we look at the S&P 500, resistance is clearly going to be at this round number at about 4,900. So that's ES. Let me look at which is the futures contract. I need to actually show you the underlying. As you can see, it got slapped right off this 4,900 level. It's kind of funny how humans place significance to round numbers. Why we do that, I don't really know, but we do. As you can see, this market has basically been trading within round numbers. So if you look at the top here, 4,600. Okay, look at the next top, 4,800. Okay, look at the bottom here, roughly 47. It's just kind of interesting, right? This market is basically, just ranging within these whole numbers. So if the market over the next few weeks behaves like it has, it's likely just to range here for a little bit before the next move up. How long will that take? I'm not really sure. I don't really think you need to really know that. The main thing is, for now, you have a call resistance level, a gamma level at 4,900 that's likely not going to be broken. And you also have now, put support at about 4,800. So you're likely to get buyers here, likely to get sellers there. And that's how this market will likely trade for a few days or maybe even a few weeks. We'll see. I mean, it took about 20 or 36 days to break this range. And this is really healthy, normal price action. Now let's zoom out on a little bit of a higher time frame and talk a little bit about where this market could go over the next few weeks. Again, I don't like to speculate too much on the higher time frame, but I do think it's important to have a thesis if you're going to maintain open positions, open spot positions in crypto or whatever going into the next year or two, right? You need to know where the wind is blowing. So let's just talk about that from a technical standpoint, and then we'll move to the fundamentals. And this is for the stock market, which will kind of translate this into crypto. If we look at the S&P 500 month over month, I'm going to remove these drawings. We can see pretty clearly that this is a very bullish market. The farther you zoom out, the more you realize how bullish this market really is. We had this big pullback, okay, in 2022. It was about a 25% correction. And the market had this huge accumulation range over, I think this was like over a year. Okay. Breakout. Again, these are monthly candles. And then you had this 3-month pullback. And then another expansion that you had towards the end of the year. What is this chart telling you? What this chart is telling you is that you're in a healthy uptrend. You are in an uptrending market. You had a pullback in global liquidity here and right here. And we're going to go into why that's really important to understand what caused that liquidity pullback, the global liquidity pullback, and subsequent downtrend in risk assets. And we're going to talk about this leg here we're experiencing right now, which is an uptrend in global liquidity. Let's talk a little bit about that. This is a chart of global liquidity, okay? And it's showing you really the trend of global liquidity. So I just showed you that chart, and you saw that big downtrend in 2022. Well, the reason why that happened is because global liquidity started to decrease significantly, or relatively significantly, if you look over the last decade or so, okay? We bottomed in September of 2022. This is really important to understand because that is really the end of the bear market. But it wasn't until you got into about March, or really maybe even November of this year, that people have finally realized the bear market's over. A lot of people thought that this bear market would last a lot longer, but there's reasons why this liquidity never really continued to go down, okay, from this point. It moved up. You had a bit of a hiccup here, which was caused by bond volatility, which we're still experiencing somewhat, okay? And this was obviously the Silicon Valley banking crisis period right here, and the Fed actually helped this. During this this downtrend here, the Fed introduced a temporary program to help some of these banks that were having reserve issues called the BTFP program, which is still actually active right now. And it's really important to really look at this and understand what's going to happen next likely. Because if you're long, you want this to go up. If you're short, you want this to go down, right? Well, what would cause global liquidity to go down? Well, we can just look at what caused it to go down before. This big move down was caused by fear of interest rates, right? That was going to cause a big suction of liquidity, which it did happen. We went from about $168 trillion, so this is in the trillions, of global liquidity, to about 158.5, something like that, okay? And now we're sitting at roughly 170 trillion, okay? But that was caused by the initial kind of transient effects of realizing the Fed was going to increase interest rates. This was actually the reason why we had the pullback in liquidity here was primarily because of bond volatility. So one of the key sources of liquidity for assets is bond collateral. People use bonds as collateral. They can borrow against that collateral and invest in things. Well, as the volatility of that asset in which they're trying to borrow against increases, it reduces the amount of margin that they have. So this was that situation here, and you can follow that bond volatility by an index called the MOVE index, okay? And I think it spiked at about 120, and now it's back down to like 90 or something like that. Or no, I think it's actually at like 109. It was at 120, now it's at like 109, something like that. And you'd like to see that go down, okay? So that's something that we'll keep an eye on. Interest rates going up, yields going up. You can kind of use it as a proxy for bond volatility. As you see TLT going down, yields going up, you can kind of assume that bond volatility is increasing. Not necessarily exactly the same, but there's a pretty strong correlation there. Okay. So global liquidity is likely to continue to go higher. Why? Okay, it's important to cover this here if we're going to have a thesis going into the next few months, because there's not a reason for it to go down. That's the main reason. Global liquidity going up is being caused by a couple of different things. One of the reasons, and maybe the most important reason to cover for this video, is because the U.S. government, the Federal Reserve, has been injecting liquidity into the markets, but not really telegraphing it to people. They don't want the market to know they're doing this. So it's kind of like stealth liquidity, but yet the big institutions know this. Okay, China has also been doing this, but much more aggressively. Maybe not nominal value, but I guess in terms of they keep injecting liquidity over and over and over again. They injected, I think, 100 and or over like 200 billion a couple days ago into their markets. Okay, so liquidity is going up because the Fed has actually been loosening monetary policy. Okay, and there's some other factors that I don't really want to get into in this video because I don't want this to be super long, but there are some other ways that quantitative tightening, which was supposed to be happening, is really not happening because it's being negated. Its effects are basically being nullified, and effectively financial conditions are as good as they've really ever been, honestly, in terms of as far as global liquidity is concerned in relation to the Fed and their role in liquidity moving into the system, if that makes any sense. Okay. One thing I want to mention here, again, I don't want to spend too much time on this, but the reason why I think that it's going to continue to trend higher and why we're kind of at the beginning of this liquidity trend higher is because we're only 7% off the lows here in terms of liquidity, and bond volatility is still up. So that's kind of a damper on how explosive these markets can really get to a certain extent, at least the global liquidity, which is a common denominator for price movements. And it's really just the United States and China at this point that are really injecting liquidity. The UK is not, and the EU is not. They are actually tightening. So what happens when they're no longer tightening and the Fed's injecting liquidity, China's injecting liquidity, bond volatility goes down? That becomes what I think will be more closer to, I don't want to say the peak of this bull market, but things will look very explosive by that point. So this is why I think this is really the golden period, in my opinion, to be entering the market, really, because the wind is clearly blowing at your back now, and a lot of the risks are just not there anymore that were present just a few months ago. Okay, so what does this market care about outside of global liquidity if we're going to talk about those risks? Earnings and inflation. Okay, earnings, we're starting to see those come in. I don't want to speculate too much on those, but if those come in decent, the markets are going to like that a lot, and this market's likely to go a lot higher. If we start to have issues with earnings, that could cause a consolidation period or a pullback in the markets. How that affects crypto is more nuanced. Maybe it affects it, maybe it doesn't. In theory, it really shouldn't care about earnings, but yet the people who are investing in the stock market are also investing in crypto. So as their balance sheet is affected, they might not want to invest as much into crypto, if that makes any sense. So there is some second order effects likely into crypto, especially the altcoins. But I don't want to speculate too much on the earnings. We'll talk about those as they come in. Today we had Tesla earnings, and I think they missed barely. Inflation is the other thing that the stock market and crypto is really interested in. And it's kind of a dynamic discussion because short term, it doesn't want to see inflation going up because it wants the Fed to cut interest rates. Longer term, that's the reason why Bitcoin and the stock market is also going up, is because inflation is good for risk assets, right? So it is kind of a dynamic discussion. But in the short term, like over the next year, obviously the market wants to see interest rates cut, and as long as inflation is staying where it is or lower, I believe the Fed is just going to cut rates sooner than later. Again, there's so many people have different opinions on this. I don't even want to go into it, but I just don't think they're willing to risk a credit crisis, a liquidity crisis, breaking things in an election year. And I'll just leave it at that. During an election year. Okay. Let's move on though. Okay. So we've talked about liquidity, we've talked about inflation, we've talked about earnings. Okay, those are the three big pillars that are going to drive markets in a particular direction going forward. Let's talk about Bitcoin real quick. Well, actually, one more thing when it comes to stocks, macro, big overview. One of the risk vectors that market participants right now are analyzing is this Red Sea geopolitical shipping issue, which is basically, to get a little bit more specific, the Houthi rebels in Yemen, this ragtag military militia, has been attacking shipping vessels. And this is not going to likely be a big deal long term, but it has caused about a 12% decrease in shipping through that region of the Middle East, which likely will have an effect on some products coming into the United States and abroad, which can be inflationary. But again, 12%, probably 12% of the goods going through that region, that's probably not a huge deal. But it's something to keep an eye on. People will speculate that this is going to cause reinflation and maybe the geopolitical issue gets worse, regional war, whatever. Some people will speculate on that. So I'm just putting, I think it's good to keep an eye on it, but this is not something I think that is going to affect the markets that much, considering Yemen is really just this ragtag army, or these Yemen Houthi rebels, as they're called, are really just this ragtag army that likely is not going to be able to sustain its military campaign against the United States and the UK and other countries. Not an expert on the topic, but I don't think you have to be to come up with that conclusion. Okay. Next. So let's talk a little bit about Bitcoin. First, let's go to the technicals here. Move me back over here. So we had a sell the news event like we talked about. I think we talked about it in a previous video, and Bitcoin has really been doing what most people expected. Sell the news event, but I think people need to put it into context that we had the ETF get approved somewhere in here, right? And you've had to sell off since then. This would have probably happened either way to some extent, but this has really been accelerated and has really been a pretty aggressive pullback because there's been such a large amount of Bitcoin being withdrawn out of this Grayscale trust that has now been converted into an ETF. So just today, Grayscale sent about 20,000 Bitcoin to exchanges to allegedly sell, which is about 600 million. I think they've sent over the last few days somewhere closer to like 3 billion or something. So they're selling a lot of Bitcoin. But the amount of Bitcoin that has been pulled out of that fund is actually smaller than the amount of Bitcoin that is coming in to the BlackRock ETF and Fidelity ETF. So this is actually getting absorbed. Yes, it looks like a pretty big price movement, but considering how much Bitcoin is likely being sold, then this is actually a pretty benign pullback, a very constructive pullback. So I think the best way to look at this is just an opportunity before the next leg higher. I'm looking at levels. I'm going to go to the daily here. I'm looking at this 100-day moving average. We'll see if that holds. If that doesn't hold, then we start looking at this 200-day moving average, this EMA here, which is roughly 35K and a half. I think, as long as you stay above around 33K, this is a very bullish chart still, and you should be, in my opinion, these are opportunities to add to existing positions and to stay long. I mean, this is just not a bearish market. Global liquidity going higher. This is a new asset class that is just now open to the traditional financial, or for TradFi, for traditional financial players. They haven't really been able to buy this in bulk. They can now do that with the ETF, and the conditions for risk assets are good, like we just said. So what I'm trying to say is this is really just consolidation for the next leg higher. I don't think it's going to take long to get back to all-time high. I'd be surprised if we weren't back at all-time high by the end of this year. Okay, so I think that's all I want to talk about today. Until next time, happy hunting, friends.